Hello, everyone, and welcome back to another episode of Majlis Markets. As always, I'm your host, Hassan Jivraj. We've made it to episode 75, which is a really, really great milestone for this podcast since we started in November 2023. And please remember, this podcast will be available in both audio and video, as we're doing right now. And also remember to sign up to all of our social media channels at Majlis Markets. But now I'd like to introduce my guest once again for part two, Abdul Kadir Hussain. Abdul Kadir, welcome back to Majlis Markets.
Thank you, Hassan. Pleasure to be back.
It was a really great. I think you were in California when we spoke last time, and I heard all the birds and the planes flying, which was really great
Right.
in the podcast. But Abdul Qadir, I mean, we had a nice deep dive in part one of your background and everything. So I don't want to go like rehashing what we did in the past. But why don't you update our listeners and viewers? What have you been up to since the last podcast?
Yeah. So I was, as you remember, was in California at that time, spending a bit of time between Dubai and California. Pretty much back full time in Dubai now, and essentially focusing on really sort of growing our asset management business, both on the Sharia side and on the conventional side, to the next level. We're just about to, inshallah, soon cross the $1 billion under management mark, which is pretty good, given we started from zero back in 2017. And I think the regional markets, as we'll touch on later on in the show, have been growing significantly on the fixed income side, and so that sort of meant that there's been more investor interest, more institutional interest, and that's generally been good for our efforts to try to increase AUM. So that's been a the primary focus, I think, since the last time.
That's great, Abdul Qadir. Abdul Qadir, to begin with in this show, we talked a lot. We talked last time a lot about the dynamics of the markets and everything, and how this fixed income market in the GCC and Middle East has grown over the past decade or so. But this year, particularly, has been really fascinating to watch from the sidelines, and also you as a market practitioner who's been like buying a lot of these bonds and Sukuk and all these other debt instrument products. How would you characterize? We're in September, end of September today, but how would you characterize this year so far with regards to the fixed income markets?
Yeah, I mean, it's been incredible, like you mentioned. I think not only from a return perspective, obviously it's been pretty good. Most emerging market indices, and including the regional markets, are up in the sort of higher single digits. And if you go into sort of the non MENA emerging markets, you can even sort of look at double-digit returns in the local currency. From that perspective, it's been an amazing year. The other thing that's been a big difference this year versus years times in the past is that there's been a significant amount of issuance, and a lot of that issuance has been able to be absorbed because for the first time, I think, in I'd say at least 5 years, you are seeing significant inflows into emerging markets, emerging market funds, market ETFs, and most importantly, you are basically seeing a lot of crossover interest. So a lot of interest from high grade investment grade buyers who are looking at potentially both on the conventional and the Islamic side, are looking at this region and looking at issuances from this region, and you're seeing a lot of allocations come from actually non-traditional emerging market investors, like global developed market high yield guys, a lot of the Asian life insurance companies, which are typically developed market investors, are looking at this asset class. And that's why you've actually seen the supply, or the immense amount of supply, get absorbed relatively easily, even though one could argue that it's the new issue premiums that were available at one point are no longer available. But even then, most of these deals, you see them heavily oversubscribed, and you see them do relatively well in the secondary market.
Amazing. With regards to the issuance, like you and I have been chatting for like over a decade now about the market and stuff. But like Abdul Qadir, one thing that's really interesting to me is the diversity of issuers that are coming to the market now compared to say even 5 years ago. What would you say? Do you think there's like a good mix of like issuers coming?
I'd have to say yes and no. So I think you still are dominated by, particularly in the Islamic, fixed income market, you're still dominated by sovereigns, quasi sovereigns, and banks and real estate. I mean, those are the four major categories of companies that you see come in. yes, you've seen obviously more sort of breadth in the market in the terms of, for example, banks. You now have banks issuing across the entire capital structure, senior, tier one, tier two, the AT1s across the whole capital structure. And then you also have obviously more extension in maturities. So you have, more 10-year Sukuk, which was not very common a few years ago. And, you even have a couple of 30-year, although that's very, very infrequent. So, you've had some breadth in the market on the Islamic side, but hopefully we're going to see more. I think the Oman Telecom deal, Sukuk deal that happened, last year was an interesting structure, and hopefully we're going to see potentially more telcos both from in the region and outside the region look at tapping the Sharia market. And I think that, potentially you have other corporates. Obviously we saw the aircraft leasing companies out of the US do Sukuk, and that's a very natural bond or a natural structure for them to issue, because they are very asset heavy companies. And therefore, for them to do, AOFI compliant structures is relatively simple. So hopefully, we'll see more of those kind of issuers also come to the market. So I think the trends are positive. The pace is a little bit slower than I would have hoped for.
Abdul Kadir, I just returned from Saudi Arabia a couple of weeks ago. It was my first time visiting the kingdom since 2017, and it's just amazing to see the transformation in person, the Giga project, some of them, and just the way the society has changed over there. But like with regards to fixed income issuances, how much of the issuances by these different issuers within Saudi Arabia, particularly, is linked to the economic diversification efforts by the kingdom?
Yeah, I mean, I think obviously all of it is linked in one way or another to the sort of the Vision 2030, which is, a foundational pillar of that Vision 2030 is reduction of reliance on oil and more diversification of the economies. In some way, shape, or form, all of these issuances are kind of linked to that effort. If it's the banks issuing, the banks are, you basically issuing in order to shore up their capital structure so they could lend more to the government. And, if it's obviously the GREs borrowing, whether it's PIF or Aramco or SRC, which recently did its issue, a lot of these are going directly into sort of those diversification efforts. And then obviously the sovereign itself are doing that. There has been a significant amount of issuance, and a lot of that issuance, I think, pretty much all of it is earmarked towards these diversification efforts. Obviously, there is now, I think everybody's seen there are now obviously a little bit more selective in the way that they are looking at the projects that they're going after and prioritizing. I think that, clearly with oil prices where they are and potentially the outlook that oil might decline over the next 12 to 18 months, there is a concern, I think, within Saudi to make sure that the fiscal discipline kind of remains and that there is, proper prioritization of projects, so that we don't get into a situation where there's any sort of threat of a significant decline in credit quality. So right now it's a 30% debt to GDP country. It's a single A rated country. Just got recently upgraded this year, a few months ago. So it's, the trends are not concerning now at all. But it's good to see that I think people are aware that this is something that could become a concern down the line. And I think there is definitely an effort to make sure that spending is disciplined and that sort of the ratios and the overall credit metrics remain healthily in a safe range.
Yeah, no, I was looking at the sovereign debt levels before we came on the show, and like they're almost hitting 2017 levels. And I think that was the year, or maybe the year before that, in 2016, when Saudi Arabia first came to the international bond market, and then started issuing a lot of this. And we shouldn't also forget that they're issuing locally as well, in local paper as well as hard currency. So Abdul Qadir, with regards to the debt levels, one thing that's interesting is that someone was telling me when I was there that they're a little bit worried about the over involvement of entities like PIF within the economic activities, particularly within the private sector. Do you see that as a risk for like Saudi credit quality?
I don't think it's a risk for the credit quality in the sense that, people don't already kind of view it as part, PIF or Aramco or any of these places. They don't view them. They already kind of view them as part of the overall debt obligations of the sovereign and kind of count them in the overall leverage to some extent when they look at it. True sovereign debt to GDP is only around 30%, but if you start adding in all of these guys, obviously it becomes significantly more. But let's not forget, PIF is an extremely asset-rich institution. It also has a lot of assets on the other side of the balance sheet that it can look at if and when it wants to. So I think it just goes back to the point that I'm making, that it is a discussion now that people are having, which, in 2016, 17, 20, 21, they really weren't having, because like you said, it only started issuing in 16. But I think that, clearly there is a indication in both the domestic markets and the international markets that we probably want to prioritize the efficient projects. We want to prioritize projects that are going to result in positive return on capital. And we want to make sure that these debt levels, whether they are just at the sovereign level or they are consolidated for all the GREs, remain in a very comfortable range, so that there's no threat to the rating or, to the overall credit quality of Saudi.
Do you think, like, also one of the other things someone was mentioning to me earlier was now that Saudi Arabian bonds and I think Sukuk and also some of their equities are also in the global indices, that's led to a lot of passive flows from the US, right? So like before, you wouldn't be getting a lot of these guys sitting in America or wherever, whereas now it's a lot more international than say like in 2016, 17.
Yeah, definitely. That's a big trend. And just seeing that now, even in the currency market, because now Saudi local currency is going to be part of the JP Morgan local currency indices, which are a big, factor for emerging market local currency investors, and that's going to bring in passive flows, and that's one of the biggest Achilles heels of the local currency Saudi market has been liquidity and sort of the lack of tradability, a secondary market liquidity of these instruments, because most of the buyers and investors of these instruments were banks, which buy on a hold to maturity basis, and a lot of the paper would just get bought up and you'd never see it again. Now, I think with index guys coming in and playing, there's going to be potentially some of that paper loosen up, and maybe not so much in the old issues that are now sort of already bought up and locked up, but in terms of the new issuances that are going to happen with a certain percentage of those issuances going into the hands of these index type players, you're likely to get much more active secondary markets, and that should hopefully loosen up the market for all the players, the index players, the local players, and sort of the active guys also.
Are you not worried though, Abdul Kadir? When you look at these banks, Saudi banks, Sukuk or bond deals, like someone was mentioning to me about the number of mid markets. Obviously, Saudi Arabia in the equity space has done very well in terms of the listings, and I think there was talk of them lifting this cap of 49% of ownership on local companies. Talk of that happening towards the end of this year. But are you not concerned that like a lot of these bank issuances are related to things like tier one? Because usually, like a tier one or like a subordinated deal usually means something like NPLs or bad stuff on the balance sheet. Are you not worried that this could lead to like a more systemic issue?
There are no real indications of that, because if you actually look at the capital adequacy ratios of these banks and their tier one ratios, and you actually look at the NPLs and the NPL coverage ratios, there's really not much of an indication that that's an issue. I think the reason why a lot of these guys are issuing, a lot of the banks are issuing tier one capital, is simply because they want to keep those ratios at relatively comfortable levels. And even though that they are lending aggressively within the economy, they want to make sure that the capital adequacy ratios are in very comfortable ranges. And so they're just essentially bolstering their capital base in order for them to be able to lend on a slightly bigger scale. But I think if you look at it from a ratio and a health perspective, I think none of the banks really have much of an issue as far as that is concerned, at least at this point in time.
Do you think that there'll be more development? There should be more development in, say, the corporate market, the pure corporate market. I know it's a bit of a difficult one because, like, if you look at the only one that really comes to my mind is Al Marai, which did a Sukuk in 2017, but like a pure corporate where it doesn't have like a government relationship. Do you think
Yeah,
that
they
could be
just did
developed
one
more?
again, Al Marai, I think, or 2 weeks ago. But
That's right.
again,
Yeah.
very very tightly priced. Very very sort of a lot of it went into hold to maturity kind of accounts. Yeah, I mean clearly from a corporate perspective, there is there's hope is that there's going to be a lot more, and you're going to get a lot more diversity in different kind of industries and different kind of issuers. There's also hope. I mean, I think one of the most exciting things that I am hoping to see is the development of the mortgage-backed markets in Saudi. With the Saudi real estate company, the SRC, getting more active and potentially then buying off mortgages from the banks and then repackaging them and selling them like they do in the US, where they have like, the Fannie Mae and Ginnie Mae and all of those kind of structures. I think if you get that kind of securitized assets, market grow in Saudi, which I think it can, it's going to be very interesting because not only is that going to free up more liquidity for the banks, but also it's, I think, a very sort of relatively natural AOFI 62. I know we'll talk about that, but it more naturally fits into that guideline because then the Sukuk owners are actually owners of these Islamic mortgages, and it becomes a true asset-backed securitization, which is I think eventually what AOFI 62 at least in some format is trying to achieve. There are different things that are happening in the Saudi market which are interesting, but yeah, I mean I think from on a blanket perspective, one would say that it would be great if we had a lot more sectors issuing and a lot more different, types of companies coming out and raising capital in the debt markets.
One other issue that came to my mind, if we just move away from Saudi Arabia for a second, is the return of Kuwait, which is in the market at the moment. It's been 8 years, I think, since they last came to the international bond market, and everyone seems to love Kuwaiti credits. Do you have any preliminary thoughts on Kuwait's credit quality?
Yeah, I mean, listen, they've obviously been constrained by the local debt ceiling and the local debt laws, which they essentially had to overcome to come out and do this. People are talking something like 9 billion of issuance coming from Kuwait over the near term. So I mean, clearly there is going to be some pent up appetite, but let's not forget Kuwait doesn't really belong in the or is not part of the emerging market bond index, or like Qatar. It was taken out of that, so it's not really going to get a lot of the passive flows that potentially an index participant would get. But yeah, it's going to be it's a to some extent it's a new line item for a lot of portfolio managers. It's a new it's an issuer that hasn't come in a long time, and I think that from that perspective there will be interest. I mean, this particular deal that's in the market, I mean, from a valuation perspective, I'd say that it's not super compelling. Um, you know, it, it's if you sort of compare it to Saudi or the other stronger GCC economies, it's probably fairly valued. So it's not like there's going to be a lot of cash on the table for investors. But yeah, I think there will, just purely from a new name point of view and an infrequent issuer point of view, I think there will be interest. But again, the other thing to keep in mind is Kuwait is probably the least diversified economy in the GCC from an energy perspective, and so the reliance on oil and oil prices is extremely high, and that's going to be something I think that investors are going to definitely look at and be concerned about.
Yeah, no, I was looking at the numbers of Kuwait's public sector in regards to its where it is on the wage bill, and Kuwait, I think, is the highest in the GCC in terms of its how bloated its public sector is compared to others. And it seems like other countries within the GCC are progressing probably a little bit faster than Kuwait has. But obviously, as you mentioned, Kuwait has its own like story with the parliament and other political dynamics. So Abdul Qadir, one thing that's interesting also is that we've seen a lot of corporate issuances from the UAE, particularly over the past couple of months. So I would say it's probably been concentrated in the real estate sector with the likes of Arada and Bingati. Do you have any thoughts on the corporate issuance market from the UAE?
Yeah, I mean, I think it clearly is I would say a bit concerning to us that you've been getting a lot of repeat issuance, particularly within the Dubai, Sharjah real estate sector, or Arada, obviously the Sharjah issuer, Bangati, Soba. These are concentrated Dubai-based issuers, and that they've done multiple deals this year. It's not just one. So, and most of those deals have done very well. The book has been good. The deal priced at the tight end of the range as far as the issuer is concerned, and it's tended to stably. So from that perspective, I think it's good. But I mean, again, it's a relatively concentrated space. There is obviously Dubai real estate. I mean, you've got Arada, you've got Soba, you've got Benghati, you've got Damak, and then potentially there you got Omniat, and then there's potentially other guys coming, or could be in the pipeline also. It's something that from our perspective, it requires an increasing amount of discipline. To sort of figure out which one of these companies we want to play in, what spread levels, what yield levels we think are attractive enough for us to play in them. For now, the fundamentals of the market are strong. There's no argument about that. Dubai, whether it's due to immigration, whether it's due to tourism, whether it's due to the growth in other industries. I mean, real estate has been doing relatively well for the last few years, and you talk to most real estate experts, they're going to tell you, yeah, you might see a little bit of a slowdown, but no one is expecting the kind of crashes that you've had, in the past in this cycle in Dubai. So the fundamentals for most of these companies are relatively supportive, but you've got to make sure that the companies themselves are well disciplined, are utilizing the capital that they obviously are getting very easy access to these days, are utilizing it efficiently and in a manner that's going to increase and improve the credit risk and the credit worthiness of the borrower. And that's kind of what we're focusing on. We want to make sure that we are comfortable that the capital is being utilized to enhance the overall profile of the company, not just the growth prospects, but also just the credit strength, the underlying asset quality. All of that has to remain robust for us to be convinced. But we would clearly like to see more diversified non-real estate issuance from Dubai and the UAE, but it's not really happening right now. It's primarily focused on this sector.
Do you think a bubble is emerging within Dubai's real estate sector?
I don't get the sense it is, because I don't, from what I can see, the amount of speculation in the sector is still not uncontrolled like it has been in the past, like it was in sort of 2007, 8 before the bubble burst. It was before 2014, before the oil price crash. So I think it's there is a lot of genuine end product demand that is there, that's coming in from people, emigrating from Europe, from the UK, from the Indian subcontinent. So, I think at this point, I don't think we've kind of reached the speculative frenzy that would, genuinely concern one. But I think that it's something that definitely the trend is getting there. And if if you start getting into that, the time period where, people are lining up to get tickets to the latest project that's going to be released from Imar or whatever, then I think you're going to, obviously start getting concerned. But I think for right now, it seems like, there is enough of a balance in the market that, you may see a slowdown in prices, but yeah, I don't think you're going to see a major drop off.
Yeah, no, because when you go on social media and you have a look, and everyone seems to be a real estate broker in Dubai. It's quite interesting seeing all the posts about the Dubai real estate market. So it seems like it's doing quite well. But do you think, like you mentioned about the corporate issuance, right, where there isn't as outside of the real estate sector and say the energy sector, do you think that's also because like a lot of these guys can still go to like the bank and get bilateral financing, or they can get like syndicated financing from the banks rather than going into the public market and issuing bonds or sukuk?
Yeah, I mean, I think that's obviously the primary reason that's happening, because, bank lending, and also, maybe we'll touch on it a little bit, but I mean, there is, it's maybe not as relevant to the top tier guys in the region, but, some of the second tier guys also now are starting to get access to the private credit market in the region. So, I don't think that the DP Worlds and the MAFs and the Emirates Airlines of the world are too involved in private credit. I think those guys are, obviously being able to tap their bank lines and work with their bankers. And that's why, you haven't, for example, you haven't seen an Emirates Airlines Sukuk, which, had issued a few. You haven't seen one in many years. Same thing with DP World. So, I mean, some of these guys are clearly feel that the convenience of the bank market is something that's too hard to ignore at this point in time. You're not seeing it, but I think potentially some of the smaller companies that might have come, with either private placements or with smaller size deals are kind of potentially being enticed by the private credit market, and so that's how that trend goes.
Just a quick question, like on a technical basis, when you look at like an offering document from an issuer, does you mentioned before about what they're using the money for? Does the use of proceeds play a role in like the pricing of these instruments, or do you think it's just purely based on the credit quality and the underlying business?
I think use of proceeds definitely plays a role. I mean, I think that, if the use of proceeds is for something like, a dividend upstream or an acquisition or something, typically that investors demand a premium for that kind of use of proceeds. But if the use of proceeds is simply to refinance, existing debt, then you potentially, don't have that same sort of view. So the use of proceeds, if it's explicitly mentioned, a lot of times in public deals, the use of proceeds is just general corporate purposes, right? And so that makes it a little bit more problematic to see how you can price that use of proceeds in terms of the risk premium that you're willing to charge the issuer. But I think in other instances, it's very clearly stated that this will be used to upstream a dividend, let's say, or be used for a new project, or to refinance or buyback. So in those cases, clearly, the investors will evaluate what sort of premium they want to charge the borrower for that.
If we just take a step back and look on a more macro scale, Abdul Kadir, we've had a very interesting year so far with Donald Trump. And his, there's not a day where I don't like look at the social media and he's not said something inflammatory or said something like really ridiculous, but and it has an impact on his policy and on top of his policies as well, with regards to tariffs and other things as well in the US debt ceiling. But how would you say that the current US interest rate cycle is playing a role within the GCC issuance space?
Yeah, so I think that's an interesting question. I mean, I think that there is a couple of things that are happening. So the first thing, obviously, as the Fed starts cutting, given that these are pegged currencies, the local banks are going to have to follow. And if the local banks follow, that essentially has an effect on your deposit rates, on your wakala rates, on money market rates in the region. And as long as the yield curve stays relatively steep or continues to steepen, which essentially means the long end of yields are not coming down as fast as the short end is coming down, what you're going to see is investors, or you're going to see basically a lot of the cash that was sitting in these wakala deposits and these money market instruments kind of start moving into the longer duration part of the fixed income market, which is sukuks and so on, because the pickup in yield is going to be attractive enough for them to do that. I mean, one of the biggest headwinds for a fixed income manager like myself over the last few years was you had an inverted yield curve. So when you went to try to raise money, people would say, why should I invest in your fund, which has an average duration of 3 or 4 or 5, where I can get higher yields by investing in 6-month CDs. So that narrative is going to be flipped on its head, and you're going to get significantly lower money market and deposit rates. And so people are going to have to look at longer term things in longer term instruments in order to earn yield. So from that perspective, I think it's going to be interesting. I think from a U.S. policy perspective, the single biggest risk that I see, and to be honest, I think this is the single biggest risk for fixed income over the next 12 months period across, whether you look at geopolitics or you look at, oil prices or whatever. The single biggest risk, in my view, over the next 12 months is a Fed policy error, which essentially means that the Fed is cutting at a point when inflation is still well above its target. And yes, the employment market is starting to slow down and starting to weaken. But if you look at the U.S. consumer, which is typically the largest driver of growth in the U.S., the U.S. consumer is still spending. money, like, they're not concerned. So if you look at the personal spending, personal consumption, personal income numbers that just came out last Friday, if you look at retail sales, retail spending, they're still relatively strong. And so if you get into a situation where 3 months, 4 months, maybe even 6 months from now, the labor market stabilizes and starts to rebound and inflation is still relatively elevated, the Fed is going to be in a tricky situation, right? Because at that point in time, do they come back and not only stop cutting rates, do they come back and actually raise rates in order to control inflation? And that kind of mirrors what happened in the late 70s and early 80s when Volcker had to come in and do that. To me, that's the single biggest risk in the fixed income market now over the next 12 months, because that would cause multiple levels of volatility. So clearly, obviously, you'd have interest rate volatility, which would make things difficult. Spreads are extremely tight in the market, and so spreads are not pricing in that kind of volatility. So if you were to get that volatility, not only will interest rates potentially rise, spreads would potentially widen, then that would make things worse. And then the final effect would be you've had this huge secular trade that's been done over the last 12, to 15 months because people expect that there's going to be continued secular dollar weakness. So emerging market currencies are generally, seen as being relatively attractive, and you've had a huge inflow of investments into, for example, the Egyptian local currency market, the Turkish local currency market, the Nigerian local currency market. These are because people are just of the view that, hey, these currencies are going to remain relatively stable, and even if they decline, they're going to decline a lot less than what the onshore local currency interest rates are, and so our total return is going to be attractive. As an example, in Turkey, if you're earning 40% in Turkish local currency paper, and the currency declines 20% over the next 12 months, you still earn 20% in dollar terms. And so that kind of trade has been extremely attractive. But the underlying thesis of that kind of trade is dollar weakness, is the fact that the Fed is in a cutting cycle, that the US economy is starting to slow down, and therefore, there's a case to be made for a weak dollar. But if that fundamental assumption gets challenged because the economy in the US starts to sort of, stabilize and start running hot a little bit, and so that dollar weakness scenario kind of comes off the table, that would cause a huge unwind in all of these local currency trades, which would essentially then increase volatility even more for emerging markets. So you'd have a triple whammy. You'd have basically rates going up, spreads going up, and local currency trades unwinding. And so the impact would be significant. It may not, we can argue about whether it's a high probability event or a low probability event, but clearly it's a very high impact event in my view. And I wouldn't say it's a low probability event. I don't think maybe it's not a high probability event at this point, but it's a medium. I think there's a decent chance that you get reacceleration in growth in the US in the next 4 or 5 months, and the Fed finds itself in a very difficult position.
Just off the back of that, how devastating would it be if Donald Trump got rid of Jerome Powell in terms of Fed independence?
Well, I think what's going to happen there, clearly it will, Fed independence or central bank independence in general for democratic countries is sort of one of the foundational pillars of their economy. So if that comes into question, obviously that is going to impact things like, inflation premiums and inflation expectations. And so, what you could have in that situation is, okay, you find yourself with a compromised Fed, which is heavily influenced by Trump and Besant and all of these guys, and you have a Fed governor who is potentially a lot more dovish. So what does he do? He says, okay, growth is stabilizing in the scenario that I'm painting. It says growth is stabilizing, inflation is still a little bit of a concern, but I'm not confident about this growth stabilization actually being sustainable, so I'm going to keep cutting rates. Okay. In that situation, ironically, you are in a little bit. You're actually doing a little bit of ergonomics because you're going back to the Erdogan philosophy of cutting rates when inflation is high. But that argument aside, what that would do is that would essentially manifests itself in the yield curve. So what would happen is that you would cut rates on the short end, the market would be like, I can't believe you're cutting rates because growth is stable and inflation is high and you have no reason to cut rates, but because Donald Trump is telling you to cut rates, you're cutting rates. Okay, I'm going to charge higher and higher, in premiums and term premiums, and so the 3-month rate, the 6-month rate may come down, but the 10-year rate and the 30-year rate will not only not come down, it may increase. Then what happens is, just kind of taking this argument to its conclusion, is the Fed says, or Besant says, or Donald Trump says, oh, wait a minute, I don't like the fact that long-term rates aren't coming down and short-term rates are coming down. So what I'm going to do is I'm going to effectively practice yield curve control, which is what Japan did, in the past, and I'm basically going to force the banks and maybe even the Fed to buy long-term treasuries so that long-term treasuries start coming down in yield. And you could do that essentially by changing some of the ratio requirements on banks and allowing them to hold more and more long-term treasuries. And then obviously in a final situation, you basically force the Fed to start buying long-term treasuries. I don't think we get there, but I think that clearly there could be changes to sort of the liquidity ratios and requirements for banks, which will allow banks to buy long-term treasuries and therefore, cap the treasuries. But what happens if that happens is the dollar just essentially weakens and weakens tremendously. So, we all saw what happened to the yen when the Bank of Japan, sort of undertook yield curve control. And that goes back to the whole dollar debasement argument and, the attractiveness of gold and all of that kind of stuff. So that's clearly, I think, a realistic possibility in the next 12 months. It could be, if we sat and did this podcast 12 months from now, we could be talking in a very, very different environment.
Yeah, it sounds like from what you're painting, it's like a very negative picture of the US, and it doesn't make sense to me. Like the stock market valuations are at an all-time high, gold is rallying at an all-time high, tariffs are high, dollar is low. Like it doesn't really seem to make sense of how it's feeding into the US data.
Yeah, again, the stock market, again, obviously relatively narrow in terms of the way it's grown. It's very AI driven, very tech driven, and that's clearly another angle to it all. But I think if you look at the fundamental underpinnings, clearly there are issues on the horizon that one has to be aware of.
Then, with all of this in mind, how does that play into the GCC fixed income space? Would you say the Gulf is quite insulated from a lot of this risk?
Yeah, that's again a very interesting question because just this morning I was looking at the Abu Dhabi 2034 bond, and the Abu Dhabi 2034 bond was actually trading 1 basis point inside U.S. Treasuries. So it was actually trading with a negative spread. It hasn't really happened before now. Some of the large U.S. corporates like Microsoft and all, you're starting to see that happen, but you haven't really seen that happen with non-U.S. issuers. So I think that the argument, or at least the thought that, hey, some of these issuers in this region or some of these countries in this region, are potentially better credits than even the U.S. government. Now, I don't think that's the case because the U.S. government at the end of the day has the dollar as its reserve currency, and therefore it has a weapon that no other government really has. But, purely from debt sustainability, debt serviceability perspective, countries like Abu Dhabi and Qatar are definitely better credits than the underlying U.S. government at this point in time. And so from that perspective, one could say that if you continue to get volatility in the U.S. and potential issues with credit quality in the U.S., given the strength of a lot of these GCC economies, GCC should generally benefit as a safe haven trade. The risk to that is if you get a debasement of the dollar and you've got peg currencies in the GCC, then essentially, what do these economies do to their currencies? Do they kind of let them get debased also along with the dollar because they're pegged to the dollar, or they decide to either repeg or free float their currencies And and can they even make that decision given the political connotations of such a decision? So, I mean, I think, those are some of the challenges that the GCC will have to grapple with. But I think from a fundamental credit perspective, despite all the high issuance, despite all the sort of increasing debt levels in places like Saudi, it still remains a relatively robust credit region, and it remains a safe haven region for a lot of the investors.
One thing that came to my mind, Abdul Qadir, is when I was in Saudi and talking to a few people there, local people, they said this was just in the wake of the strikes on Doha by Israel, and that caused a lot of shock and outrage, obviously, rightly so, for the Gulf countries. But one thing is that there's been a lot of geopolitical events. You can talk about the Red Sea. You can obviously talk about the devastating stuff taking place in other parts of the region. How would geopolitics, do you think, if things like because one of the things they said to me is that the 12-day war between Israel and Iran really had them on edge. Do you think if something like that took place again, this would have a bad impact on the market?
I mean, I think it put a lot of people on edge in the region. But if you actually look at, bond prices and spreads and, asset prices in general in the region, they had a small little blip, but nothing that was earth shattering or nothing that was, sort of repriced the entire market. You had a small blip, once the tension started dissipating, everybody came in, tried to be the first one to buy the blip, to kind of buy it. And before you knew it, things were kind of tighter and higher again. And that's been the case, throughout all the geopolitical volatility that you've seen ever since, the unfortunate events of October 7th, right? So whether it's whether it's the actual 12-day war, whether it's the Doha situation, whether it was sort of the targeted assassinations in Iran that happened earlier, all of that stuff, whether it was the disintegration of the Assad government in Syria, generally the market just looked through it, was not concerned, didn't think it was going to make much of a difference. To me, the only sort of challenge to that in terms of sort of a long-term or potentially a complete repricing of the market would happen if you obviously saw the conflict really spill over into the GCC economies and kind of do that on a sustainable basis, not just a one-off, pre-planned, messaged, strike, but something that was a lot more broader and problematic that could, potentially derail the pricing. But, I don't see that happening. So I think politics are unlikely to, in the current realm of things, geopolitics are unlikely to reprice the market.
Before we get into Sukuk and AAOIFI, one thing I wanted to ask you, Abdul Qadir, before the Gulf countries became independent, a lot of them used the Indian rupee as a form of legal tender. And, you talked about dollar debasement and the weakness of the US dollar. With the UAE being a member of BRICS and Saudi Arabia doesn't know whether right now it's a member or not, and with the changing alliances and the growing influence of China and India within the Gulf, within the trade sphere, are you surprised basically that we haven't seen like any kind of debt issuance in another currency other than from the US dollar?
No, so they are issuing. You do see, I think Abu Dhabi just recently did a euro deal. It was, so you do see GCC guys look at, non-dollar deals. You've had, for example, in the past, banks in the UAE go out and issue in renminbi. So it's not something that's unthinkable. You've had that happen. Potentially, just you've had them issue in yen. So it's really, at the end of the day, it's very much an economic decision. Wherever they feel that they can issue at a level that is efficient for their capital structure, they'll do that. There's obviously also a scarcity aspect to it. If they're regular dollar issuers going into a non-dollar market as a diversification in terms of trying to just pick up a scarcity discount, is something that you see a lot of the issuers, particularly on the bank side, take advantage of.
And if we move to Sukuk, which everyone wants to talk about, I know you've got views on this. The Sukuk market's obviously done very well this year in terms of the issuance, but obviously there's a big elephant in the room, which is AAOIFI Sharia Standard 62, which we spoke about on the last podcast. And I spoke to Omar Ansari from AAOIFI to get his views, and I've spoken to other people in the market. It's still an exposure draft Standard 62, but from what I've been hearing from sources and from people within the UAE, the central Bank is still pressing ahead with AOFI standards on IFIs. How would you characterize the current situation?
Yeah, I think, and by the congrats. I think your conversation with Omar was very good, and I think that you've done a great job on this topic overall. I think that it's if you look at it, it's obviously for right now the UAE, and I think even a couple of the other economies in the region are committed to AOFI, and I think that's kind of what they want to. That's what they want to do, and I don't think that's necessarily a bad thing. I think it's good to have try to establish standards. I think that we will. I'm optimistic. I'm always optimistic. So I think that we will reach a reasonable conclusion to this debate, and we will come up. I'm pretty sure that the AOFE at the end of the day will come up with something that will, maybe it will take a little bit of time for the market to absorb and understand, and it may even tweak the nature of the market to some extent. I don't think it's in the AOFI's interest, and I don't think it's in the interest of any of the participants in the Sukuk space to just sort of blow up this market and make it purely an equity-based market and no longer a fixed income market. It's now, you cross 1 trillion Sukuk outstanding. Yes, it's a small amount. It's a drop in the bucket in terms of, global debt outstanding or whatever, conventional debt outstanding, but it's still significant growth as far as the Islamic market is concerned. And so I don't think that you can just kind of wipe that off with the stroke of a pen. But I do think that there will be, an effort to link the returns on Sukuk more closer to the underlying assets. But it's just going to have to, I think AOFI is going to have to work with the industry to figure out a way to do that. That is, that doesn't sort of change the underlying fundamental structure of the market. And I think they will do that. I think that's why you've had so many consultations and so many back and forths, because they are trying to make sure that that's that's the way that it happened.
Yeah, I mean, critics would say Sukuk in the current sense mirror bonds, and we can have a debate on that, but this standard, a lot of people were saying to me, is that it kind of exposes Islamic finance for being just Islamic in name but not in practice, in the sense that these Sukuk don't really give investors the risk, as you've alluded to with the equity. I mean, do you think that it's probably better to develop the Islamic finance ecosystem, in the sense that you have Awqaf, you have deeper pocket investors, you develop the securitization market before you introduce a standard like this?
Yeah, I think that would have been the right way to do it, right? I mean, I think that and that's why I was hopeful of the Saudi asset-backed, asset securitization market, because I think the easier way to have done this would be to first develop those kind of products and structures, and then develop investors around those kind of products and structures, and get everybody comfortable with securitization essentially as an Islamic instrument, and then potentially come up with the standard and slowly transition everybody away from the traditional sort of asset based structures to the asset backed structures. But I think that it's not transpired that way, but it could be that eventually in a roundabout way that's where we get to. Hopefully it doesn't cause a huge amount of disturbance in the market, and so that's the hope, that we kind of get to that situation. Yeah, I mean, again, it's one of those things where 6 months, 9 months, 12 months from now, we could be in a very interesting place to have another conversation.
Just on this point, before we just look ahead to 2026, Abdul Kadir, I remember when I was writing an article last year, you gave me some really interesting points about if this standard did come in unrefined, I don't want to use the word devastating, but how impactful would that standard be if it was not refined?
Well, I mean, it changes the entire nature of the market, right? Then there's so many things that are different about that structure than the way things work currently now. So, an investor only has recourse to the asset, right? So if the asset doesn't perform, so if MAF issues a Sukuk and securitizes that Sukuk with the proceeds of the Mall of Emirates, right? And for some reason or the other, the Mall of Emirates, doesn't do well. And, as people stop going to the Mall of Emirates for whatever reason, investors can't do anything to MAF. MAF has 50 other malls that are operating and doing what they're doing, and no, doesn't matter how profitable they are, and MAF could be supremely profitable at a corporate level, but just because the asset that was backing Sukuk that was issued didn't do well, that's tough on the investors, right? So you've got a situation where the corporate generally is perfectly healthy and doing very well, but Sukuk investors potentially have suffered a significant loss. Secondly, that's one issue. The second issue is from a sovereign issuer or a bank issuer side. If you're a sovereign issuer, what asset do you hand over? What asset, how do you, and that's where I think where some of the flexibility will come in. I think that they will, AOFI was going to have to figure out a way of saying this is the asset that's backing this, but in terms of ownership, they're going to have to figure out a way that even though maybe for the life of that sukuk, that ownership, belongs in a certain way to the sukuk holders, but they don't have certain rights over it. I don't know. I'm not a Sharia scholar or an expert, but that's kind of where they're going to have to come up with the flexibility so that sovereigns and other issuers have the ability to part with an asset without feeling that they're letting go of something that is may be of strategic value to them. So that's, would be a second issue. And the banks, for banks, how do banks part with an asset unless it's through a securitization of loans? It's going to be very difficult. And those are some of the biggest issuers. Sovereigns and banks are some of the biggest issuers that you have in the space. So, it would definitely, if it came about in a completely, unwatered, not, I wouldn't say watered down, but if it came across in the form that the market was originally, scared of, let's say, then it could cause significant disruption to not only the issuance of Sukuk, but investors in Sukuk also.
I mean, do you see the argument from people who are saying that this standard is needed in order to differentiate the Islamic finance industry?
Yeah, I know. I absolutely. I'm one of those guys who definitely feel that we've lost our way. When we start doing things like Sharia wrappers and wrap conventional assets in order to generate Sharia returns, you clearly lost your way. Do we need a fundamental reset to kind of bring everybody back to where we were supposed to be going? I absolutely agree with that. I just I just think, like you said, that there were potentially were different ways to go about doing it. But maybe one can argue there weren't. Maybe one could argue that you had to shock the system in order to kind of do this. But hopefully, I think that the shock to the system is not going to be debilitating enough that it kind of destroys the system. It just kind of resets it, and maybe we have a few months or even a year or so of volatility, but then we kind of get back on track. Because I think that it's potentially what's needed.
Yeah, yeah, and I think the other point that someone mentioned to me is the enforceability of the jurisdiction of how
Yeah,
far are they willing to enforce it.
that's a big issue. Absolutely.
But Abdul Qadir, as we bring the podcast to a close, one of the things also I want to talk to you about is the outlook for 2026. It's amazing to think that we're already in October nearly. What are your what's your thoughts for the rest of 2025 and going into 2026?
Yeah, I mean, I think I go back to my, the point I made about the single biggest sort of fundamental concern or risk that I have, which is essentially a reacceleration of growth and inflation in the US, which causes the Fed to have to unwind the policy that it's just embarked on in September. I think that, that's your single biggest source of risk, because I think that cause multiple issues. The second source, again, like which is you brought up, I think, is obviously Fed independence and the ability of the Fed to kind of call it as it sees it. I think if that gets compromised, then you potentially, as I mentioned, have a scenario of increasing term premiums, increasing inflation premiums, steepening yield curves, which eventually leads to yield curve control, which eventually leads to dollar debasement. So those are sort of some of the risks and concerns over the next 12 months. I think that the other side of the coin is, you get a sort of relatively normal cyclical weakness in the US. You don't really get a reacceleration. the Fed eases, the economy starts to stabilize, inflation doesn't reaccelerate. In fact, you could conceivably make an argument that inflation eases because employment is slowing down, and so labor costs potentially come down. Labor costs are a big component of the overall inflation picture. Labor costs come down, AI efficiencies take place, tariffs are not that, don't have that same impact that people expected to have, and so essentially inflation stays relatively under control. And then in that scenario, you've got a relatively Goldilocks type of environment. You get, the fixed income market probably returns you in the mid single digits, somewhere from 6 to 8% total return, of which, you know 5 to 6% comes from the coupon, and probably 1 to 2% comes from capital appreciation as rates come down. That's probably the more likely scenario, because I think that's the scenario that the market is anticipating. But I think they're pretty fat tails. So I think that it's not a sort of 90% probability of that scenario and then 10% each side. I think it's probably more, sort of a 60-20-20 type scenario. I think that the uncertainty levels for the next 12 months, particularly obviously when you've got a U.S. administration that tends to be quite reactionary and kind of do a lot of off the cuff things, that uncertainty is going to remain. So I think in a nutshell, probably most likely, hopefully, we see a relatively stable year. But I think there are some genuine risks to that view. And so for me, from my perspective, the way I manage those is that I'm very disciplined about how much, sort of interest rate risk I take in my portfolios. I watch my duration very carefully. I don't want to be caught out in a situation, like I said, where the Fed has to come back and increase rates, or where the term premiums start increasing and long end rates start going much higher. And you know, if I can maintain that discipline, then I think that given how much yield there is in the market, which is around 5% now on general for high grade regional bonds and Sukuks, I feel that I can have a relatively decent year without the volatility that might come from taking outsized bets on the Fed cutting rates, or whatever you may have.
The Kadir, one thing that just came to my mind as a personal question to you, you're a CFA holder, you've been in this industry for a very long time. How much has AI or how much does AI play a role in your analysis? Because I was reading an article the other day that the AI learned how to do the CFA level 3 and passed it with flying colors. I mean, are you worried that AI could take your job or no?
Um, I think AI can definitely take aspects of my job. I think if you look at it from an analyst perspective, the type of functions. I mean, I started my career off as a credit analyst, initially, and 75-80% of what I used to do at that point as a credit analyst, an AI engine can do for you now, right? So I think that a lot of these machine learning type things will go in, they'll get you the data, they'll scrub it, they'll give you the ratios, the trends, they'll give you the risks, the weakness, the strengths, the weaknesses of a credit. They could even potentially make a recommendation of saying, this is why I think you should buy it or not buy it, which essentially covers the entire spectrum of kind of our role. But at the end of the day, you still, they may not be able to judge, what kind of environment, what kind of flows are expected, or, what's the new issue calendar, how is that going to affect issuance. So there's always going to be some form of judgment that's required into finesse your decisions. So, what I tell young analysts and what I tell younger people coming into this industry essentially is, it's not that your function or your role, will become redundant or not useful. It's just how you accomplish that role is going to change. So, get familiar with how to operate all of these AI tools. Get familiar with how to ask the right questions, how to get the right outputs, all of that kind of stuff. And that's where your skills are really going to come in, as opposed to knowing how to calculate a certain ratio, or dig out certain numbers from the balance sheet of a company, because that stuff you're going to be able to have it done for you but right questions is going to be key.
Yeah, you still need the human input, I think, for the prompts. But Abdul Kadir, tell us any projects you may be working on, any upcoming projects you may be working on.
I think we are obviously from an asset management perspective to look at different products that we can launch. Potentially looking at balanced Sharia compliant debt and equity product. Potentially looking at more money market type liquidity management type products. So yeah, I think from a new project, those are the kind of things that we're looking at right now.
But Abdul Kadir Hussain, this has been a really great catch up and a really insightful one to hear about the markets and what your thoughts are on AOFI and all the other things. But Abdul Kadir, once again, thanks again for coming on the podcast.
Thank you very much. Thank you.